On Tuesday, two public companies took 3 years off them by investors, when they became the first to sell euro bonds with a negative yield to maturity. Henkel, a German consumer goods manufacturer, sold 500 million euros of 2-year bonds with a yield of minus 0.05%, while Sanofi, a French pharmaceuticals manufacturer, sold 1 billion euros of 3.5-year debt with a yield of minus 0.05%. Borrowers being paid by their lenders is not entirely new. Many Eurozone government bonds have traded at prices which imply negative yields for 2 years. But lending to companies is supposed to be much more risky. So Tuesday's news is the latest step in a process where riskier and riskier kinds of debt start to be sold at negative yields. But why would people buy debt that they are seemingly guaranteed to lose money on? The answer is because it is one of the least bad options. 2 years ago, the European Central Bank cut its deposit rate below zero for the first time. This is the amount commercial banks are paid, or rather they now pay, on money they leave overnight at the central bank. Banks have passed this cost on to customers, particularly companies and pension funds with large account balances. In March, the ECB cut the deposit rate even lower to minus 0.4%. This has led companies and investors to seek out other safe assets. Bonds with negative yields become attractive, so long as these yields are less punishing than those on cash in the bank. Having cash is a problem for banks, investors and companies. Holding on to money is like trying to hold on to a hot potato. You want to find something to do with it very quickly and pass it on to someone else. Now Henkel and Sanofi themselves have this problem. Having sold negative yielding debt, they now hold even more deeply negative yielding cash in their balance sheets. While they are being paid to borrow, they pay even more to save.